THG Nutrition is currently on a 5-quarter losing streak, but will an upcoming corporate restructuring move change its outlook? So I'll decode that introductory statement or question a bit later in this content, but since THG, aka the company formerly known as the Hut Group, did just release their latest interim trading statement, I thought it would be practical of me to start this content off by running through some high-level financial data. This will obviously update you on how the brands within the THG Nutrition segment performed recently, but more importantly, give context for my expanded strategic commentary on the global supplement market dynamics and trends. And just some kind of quick financial mumbo jumbo housekeeping for the bulk of my audience. Since THG is not an American corporation and has different reporting standards for their public markets, this report will be lighter on financial metrics. Also, I did the currency conversion on all of these revenue numbers, so you'll be hearing these numbers in US dollars, not British pounds. Moreover, I'll be using the constant currency percentages, which just means the currency fluctuations of this multinational company are stripped out for the ease of comparisons. Additionally, for those that might not be too familiar with THG, the company is currently made up of several different divisions. There are 2 branded product divisions that focus on the beauty category and then the previously mentioned nutrition category. And while I believe understanding both branded product divisions of THG is important, this piece of content will only focus on updating you on the THG Nutrition side, which includes the world's largest online sports nutrition brand, MyProtein, and its family of sub-brands, the largest of those being MyVitamins and MyVegan. Finally, THG also includes a proprietary end-to-end direct-to-consumer e-commerce SaaS solution called THG Ingenuity that will become a central theme throughout this content. But let's start off with a quick financial overview of THG Nutrition. In the third quarter of 2024, THG Nutrition reported generating revenue of approximately $174 million, which was down 10.5% year over year. If we look at the first 9 months of 2024, THG Nutrition didn't fare much better, generating revenue of approximately $563 million, which was down 7.4% year over year. So what's up with these extremely poor results when you consider that the overall global supplement market continues to perform strongly? Well, if you've consumed these THG Nutrition quarterly updates throughout the last year or so, I had been running through a large collection, maybe 5 to 7 strategic decisions impacting results. But I want to streamline this particular content piece because of the extra THG Ingenuity Demerger second order effects commentary that I will be adding to the end. But let's start with arguably the most important one first, which is the biggest rebrand in the 20-year history of MyProtein. And this has been interesting to watch from afar, especially because this is something that really exposes smart people when they get outside of their general area of expertise. Point in case, investment analysts during these earnings calls don't seem to be able to understand that packaging refreshes and more comprehensive rebrands usually impact near-term sales adversely. Moreover, their inability to comprehend the massive undertaking to seamlessly reposition and evolve the business model of an almost billion-dollar sports nutrition legacy brand that operates in 70 territories and has several thousand SKUs. But THG leadership stated early customer feedback looks to be promising, with brand awareness, consideration, and perception all demonstrating year-over-year improvements. Additionally, transitionary impacts from the rebrand are now behind MyProtein, so the last year of poor revenue performance has reflected in part its decision to temporarily reduce product ranges and keep new product launches to a minimum across each market. But also consider that MyProtein offloaded old packaging products online, which can result in a slower sell-through compared to offline clearance retailers. And this rolls into the other strategic decision that I wanted to cover because THG Nutrition intentionally sacrificed speed for lower visibility, as it would ensure MyProtein had the best chance of continuing to move upstream in positioning, thus unlocking more global sales channel diversification opportunities. Yes, THG still mainly deploys a global digital-first commerce strategy with about 85% of its total revenue coming from its direct-to-consumer or online marketplaces, but THG Nutrition has continued to invest in offline retail partnerships where they place a limited or exclusive SKU range as part of a bigger demand generation strategy. In terms of the offline global retail landscape, MyProtein is now stocked in over 20,000 retail locations and grew 17% year over year this quarter, which is expected to help drive the retail mix closer to 75-25 over the medium term. One such example of physical retail expansion that continually gets highlighted by THG leadership is the development of MyProtein products that are sold under licensing agreements. When done correctly, these types of retail partnerships boost customer touchpoints and broaden brand appeal. Currently, this strategy is being deployed in the brand's two largest markets of the UK and Japan. But I want to shift this final part of the content into what I was referencing in that introductory statement, which was that THG Ingenuity will demerge into a standalone independent private entity. And I'm less concerned about analyzing the recent performance of THG Ingenuity, its expected enterprise value, or how it's getting funded. Instead, I'm more interested in how this demerger will directly or potentially indirectly impact THG Nutrition. Because if you didn't know, the THG Ingenuity platform is a full vertically integrated e-commerce solution spanning the entire product and customer journey, from content creation, marketing, and digital commerce through to leading websites and integrated global payment, hosting, courier, and logistics networks. And listen to what I said about it more than 4 years ago in a piece of content.
And it has a lot of similarities, or at least kind of remnants of what you would think about when Amazon was first starting, especially thinking about they've built this Ingenuity kind of platform, fully customized end-to-end e-commerce and operational system for themselves. But what they realized was it was so unique, so valuable, that they were going to go out and start selling that. I think they started in the last 18 months, they started actually selling that to other companies. So this is similar to like what you'd think about with Amazon when they built Amazon Web Services, or a number of other products that they've created for internal use, but then monetized as kind of white labeling for the rest of the market. The Hut Group has been able to do that with this Ingenuity, with third-party major brands here we're talking about here. You have, I think, Nestle, you have Walgreens, you have Procter & Gamble, and a ton of other companies that have came on as clients to the Hut Group for this technology.
So did THG Ingenuity live up to that hype? It's complicated, because while I'm still bullish that THG Ingenuity can blossom into that billion-dollar global B2B enterprise technology company, I also think Shopify has grown far more powerful since 2020. That being said, THG Ingenuity will likely continue playing where Shopify is weaker, focusing on acquisition of the largest multinational companies by leveraging its fulfillment segment, powered by its partnership with logistics robotics giant AutoStore. But that strategic outlook leads me back into discussing how the THG Ingenuity demerger could impact the branded product divisions, but mainly THG Nutrition for the purpose of this content. THG Ingenuity is essentially the master switch that powers THG Nutrition and THG Beauty. But even after the demerger, neither can survive without the other entity. So something like a 10-year contract was put into place that reportedly started in 2022. And I'm sure you're thinking, but what if something catastrophic happens to THG Ingenuity as a standalone private company? I don't believe that would leave THG Nutrition exposed, as its customer mix of both large multinational corporations and those THG branded product divisions would create an attractive asset, even if it fell into a reorganization type bankruptcy situation. Regardless, the demerger will simplify the organization. That's obviously helpful externally with shareholders, as it will undoubtedly create a classic case of the sum of the parts being greater than the whole. And I've mentioned this previously when discussing a potential THG Nutrition IPO, but there's been a special project internally to separate the divisions and run them independently. So when the THG Ingenuity demerger becomes reality, all that kind of management, role-playing, and financial modeling internally would obviously be useful to smooth out the oftentimes messy transitionary period. As for the profits and cash flow discussion, the capital expenditures of THG Ingenuity had been previously funded by reinvested profits, mostly coming from THG Nutrition, With that demerger, THG Ingenuity will obviously take on a significant portion of lease liabilities, thus reducing gross leverage for THG Nutrition. Additionally, THG Nutrition, already the most profitable division, will then significantly improve its free cash flow profile, providing it with expansive strategic optionality. Yes, most of that extra free cash flow will be allocated to servicing existing debt facilities created from mostly THG Beauty acquisitions, but the debt ratio will quickly reach a place where things like mergers and acquisitions could become highly attractive again. But in the near term, I'd expect THG Nutrition to utilize the extra net margin buffer for more aggressive brand marketing activities. Yet, what I wish they'd focus on is making a strong effort to successfully expand formats into RTD protein beverages within the US large retail channels like mass, club, and grocery. Because if you tease this out long term, all this short term investment analyst chatter about down or up a few percentage points of revenue right now is just a distraction. MyProtein could eventually face a similar Optimum Nutrition problem. And if you don't get that comparison, Optimum Nutrition is a $1 billion performance nutrition brand owned by Glambia that's growing well because of its powders being sold in large retailers, but it could, without a fathom of a doubt, be growing much faster if it had a popular beverage format offering in protein. So, in my opinion, the real challenge that needs to be solved to unlock long term success at THG Nutrition comes down to MyProtein having a compelling protein RTD beverage option within the largest global convenient nutrition market that's given the proper resource allocation and commercialization strategy. Realistically, MyProtein could double or even triple its US revenue over the next few years, but it will likely need to come from strategic alignment between the rebrand positioning, channel expansion, and format expansion. But I hope you enjoyed the first principles thinking that went into my latest YouTube video. If you did, can you do me a favor by hitting that like button? That quick and free action helps YouTube know my content is worth spreading to more people. Also, we're getting really close to reaching my next subscriber goal, and it would be great if you join me on this journey. But to do that, we need to fix the fact that slightly more than 3/4 of you that are watching this video right now are not subscribed to my YouTube channel, and that hurts my feelings. Regardless, I want to thank you for giving me some of your attention and time, and I'll see you on the next one.